With October 31st creeping around the corner, a host of Halloween myths and legends are beginning to turn in their graves. From vicious volatility to spooktacular scams, we're diving into the most common fears encountered on your Web3 travels. If you found yourself in a ghastly crypto mood, have no fear. Follow Winnie the Web3 Witch on their trick-or-treat journey as they unmask these ghouls and crypto creepers. Together, we'll soon see that the blockchain and digital assets aren't a load of hocus pocus after all.
It's Halloween. The spooky season is in full swing and the air is filled with dread. When it comes to crypto though, it doesn't have to be that way. While the unknown can seem scary, a better understanding of blockchain technology goes a long way. To help out, we've gathered and debunked 5 of the most terrifying crypto creepers and myths. First on our list is creepy crypto, diving into exactly what we mean when we talk about cryptocurrencies. So what exactly is lurking there in the shadows? A cryptocurrency is a decentralized digital asset secured by cryptography that hasn't been issued by a government or a central bank. It uses blockchain technology to create a system that doesn't need a central entity to manage the asset. That's it. Does it still sound a little mysterious? Let's unwrap it a bit further. A cryptocurrency like Bitcoin is a lot like digital gold. It can fluctuate in value against other assets, just like the US dollar, euro, or stocks. You can also exchange it for goods and services, or pay friends with it. Some cryptocurrencies, like BUSD, even track the price of real-world currencies. So what's the key difference then? Cryptocurrencies like Bitcoin aren't issued by a government like, say, the US dollar or other fiat currencies. The government can regulate a cryptocurrency, but it can't manage or stop its supply. Crypto also doesn't rely on intermediaries like banks for transfers. With crypto covered, next on the list of horrors to demask is vicious volatility. While it may send shivers up your spine, it's really not as terrifying as it's made out to be. While markets do go down, it's important to remember that they move in cycles. Bull markets and bear markets are part of the very fabric of any stock or crypto investment. In both markets, these terms are used to describe market conditions. In a bear market, prices continue to decline from all-time highs and continuously drop. In the stock market, the value of listed companies drop, while in the crypto market, the value of the crypto asset that represent the value or utility of crypto projects declines. Historically though, there has been a reversal back to a bull market, where the markets start to recover and begin the long journey back to profitability and new all-time highs. Bull markets start to bring back confidence in economic conditions and draw investors back into the market. Bull and bear markets are caused by investor sentiment. In bear markets, the decline of prices can cause investors to sell at the current price to avoid further downside. This can become self-fulfilling, as the more investors that sell, the lower the price of a stock or asset is driven. Conversely, when markets start to recover and a reversal hints that a bull market is on the horizon, investor sentiment swings the other way. Purchases of stocks and crypto begin to increase, which drives the price higher. The return of the bull market. Just make sure that you thoroughly research the assets you're investing in and educate yourself with all aspects of the market as much as possible. With another crypto creeper debunked, it's time to take a look at our next urban legend. You may have heard of the blood-curdling myth that crypto has no utility, but that's really not the case. Utility is what powers the value within Web3. What is utility? It's the use case for a particular asset. In GameFi, a particular coin or token could power the in-game economy. In DeFi, it could power the economic architecture of the project, facilitating transactions. There are thousands of use cases, and those with the strongest utility, the reason the asset is bought and sold regularly, are the ones that will have the most credible value. As ever, there can be risk when it comes to investment, so always research any potential investment thoroughly. For a deep dive on utility, check out Binance Academy to find out more. Another of the most common myths in the crypto world is the shuffling horde of rattling regulators, waiting to regulate your crypto away. However, with a closer look, you'll soon see that regulation isn't so scary after all. Unregulated assets put chills up the spine of crypto newcomers. What looks like a simple investment could actually be an unexpected game of trick or treat. At the other end of the spectrum, some crypto pursuits are wary of too much involvement by regulatory bodies. In fact, regulation isn't something we should be afraid of. It's here to protect users from the real ghosts and goblins out there, looking to part you from your money. Regulated coins and projects provide several benefits. First, you can place some trust in them as they have been approved by a regulatory body as suitable for investors. Stablecoins, like BUSD for example, is compliant with the rigorous regulatory standards of the New York Department of Financial Services. Second, if you're compliant with your local regulations, complete identity verification checks, and use regulated services, your level of protection increases. You could then benefit from investor rights that you wouldn't have with unregulated projects and services. But what about decentralization, I hear you say? Doesn't regulation centralize everything to an extent? Well, there can be some trade-offs here, but that doesn't mean there isn't a sweet spot. A lot of crypto's innovative spirit comes from the power of decentralization. It's permissionless, immutable, and puts the power in the hands of the user. However, it's still possible to implement sound regulatory measures that benefit consumers and the ecosystem without harming decentralization. In 2022, Binance has already keenly navigated the road of regulation across multiple jurisdictions. These include licenses in New Zealand, Spain, Italy, France, Kazakhstan, Dubai, and Bahrain. With 4 myths debunked and 1 more to go, we have perhaps the scariest one of them all left: spooktacular scams. Fortunately, for us all with a little common sense, it's easy to dodge this specter of security. Falling for scams is a terrifying thought, but you should always remember that if it's too good to be true, it probably is. But do note that crypto doesn't equal scams. Rather, it's how scams can sometimes be found within the crypto economy that's what's scary. Some common swindles and tricks include social media giveaway scams, pyramid and Ponzi schemes, and phishing attacks, all of which give you false promise of returns and profits. If a giveaway asks you to send some cryptocurrency in return for 10 times the amount, it's almost certainly fake. Be sure to keep your eyes open for these. One project even offered 80,000% return on investment to participants in their scam. The moment you hear about an investment opportunity with guaranteed profits, that's your big bad wolf. Pyramid or Ponzi schemes also depend on you to bring new clients. So you may even have trusted friends invite you who have also become victims. Finally, let's look at phishing scams. Always check twice before entering any information or passwords into a website. Are you using the correct portal and have the right link? Bad actors will often pretend to be an employee of a particular crypto project and ask you for your credentials. Never give them out. Binance, for example, would never ask you for your login details. Here are some additional ways to avoid scams that you should keep in mind. The bad guys can often provide you with a crypto seller's information, claiming that it's their account, when in reality it isn't. So always make sure, in the case of Binance P2P for example, that the Binance name and the bank name are the same to safely avoid these traps. Also, make it a habit to keep screenshots of your transactions as proof of completion. At times, scammers can attempt to void the transaction or falsify receipts. So don't be intimidated and fight back using those screenshots. So by following our tips, you can avoid the terrifying breadcrumb trail to the gingerbread house of crypto scams. In fact, our tips will also help you avoid scams and pitfalls in the traditional finance world too. According to the US Federal Trade Commission, over $1 billion has been lost to scams from January 2021 to June 2022. Let's make sure your portfolio stays safe and sound. So there you have it, 5 demasked crypto creepers to make the spooky season just a little less scary. Happy Halloween, everyone!